All right, hello and welcome to Chapter 6, first video in the series of 3, as you'll observe. I begin right at the heart of the matter with this one. Again, chapter is a continuation of the previous, and that we just, continues with more inventory concepts. All right, so first thing we're going to do is just some basic setup data here. In other words, what's the inventory we're analyzing? So in this case, we got Widget Inc., which is a seller of, again, fine doohickey, simply meaning we don't really know what it is. It's just some generic good for over 100 years. So it's extra background information. Anyways, so under the heading of purchases, again, that's a little bit of a misnomer because it also includes, as you'll obviously observe, beginning inventory. It's just, I guess, a summary of all the inventory we had on hand during the period. That's the critical piece here. So we have beginning inventory 200 at 92, and then as you can observe, there was 3 purchases during the year. 100 at 98, 900 at 103, and 100 at 106. So as a consequence of this data, what do we get? What's our key pieces here? The fact that we had 2,200 units on hand, and if we total all of these purchases, and including beginning inventory, we get this figure right here. We get 219.7, so I will defer to the formula down there, which is if we take beginning inventory plus cost of all of our purchase, we get something called cost of goods available for sale. Now, what are you looking at there? You're looking at this is the way I have tried to phrase it just to make it a little bit more straightforward in some ways. It's the upper limit for your cost of goods sold. That's really the way of thinking of it. It's the total cost of everything you could have sold during the period. So in other words, if you sold all 2,200 units, the cost of goods sold for the period would be 219.7. That's not debatable. Why? Because they didn't have 2,201 units available. So they did not have that additional 1 unit. So once they sold 2,200 units, if that happened, the cost of those units total would be 219.7. Reality is, of course, they're not going to sell everything, as you will observe down here when I had this sales section I put together here. So we had 3 sales during the year. And of course, they only sold, again, not everything, 2,000 of the 2,200 units, which means they had 200 units as a remainder. This is the basic math there, available less sold. So what you'll see here is what you're doing is having to do the following. Determine, meaning allocate, some portion of that 219,700, the biggest portion, to the 2,000 that were sold, and the 200 on hand at the end of the period, look at the smaller portion. Now what's your problem here? Why is this not a simple thing to determine just off the top of your head? Well, our inventory all looks basically the same. It's indistinguishable from, and one unit versus the other. They all look the same. So we have homogeneous inventory on our hands. So a way to think of it as let's say I took a bunch of units from all of our 4 layers here. Look at it as layers, and I spread them out on a table and asked you to identify which layers came from which part of our inventory. You would be at a loss to tell me where they came from. It's just that information is not available to you at a glance because they all look the same. They're just homogeneous. As a consequence of that, this is why we have to choose a cost flow assumption. Now, what we mean by cost flow assumption is, and we'll switch to the next slide here, is how we assume goods are being sold out of the business. Now, there are 3 basic ones that we're going to tackle here, and that is first in, first out, which is abbreviated as FIFO, just FIFO. Last in, first out, abbreviated as LIFO, and then we have average cost. So what's the basic rules underlying those 3 methods there? So first in, first out FIFO, simply means the first stuff in is the first stuff out the door. So you're selling in order of acquisition. Last in, first out, you're selling in reverse order of acquisition, so from your newest units to your oldest units. And then, of course, average cost is just saying, well, we're selling stuff willy-nilly, just like 1 unit here, 1 unit there, so we're really not interested in where they're coming from exactly. So we're just going to average everything out. In practice, there's technically a 4th, I hesitate to call it an assumption because that's actually a misnomer to say assumption. It's really the reality of what's happening, and that is, it's called specific identification. I will not try to write that out with the mouse. That would be a tragedy in the making with my mouse skills as they are with this setup I have. So anyway, specific identification is just like it sounds. The company knows exactly what they paid for that one thing that they sold. And this is useful, most useful, if we're talking about a company that can uniquely identify what they're selling. The best example available is automobile dealers. In the automotive industry, every vehicle, this is I think since '65, has a VIN, vehicle identification number, on it. That tells you all the underlying information you need to know about that vehicle. That is, that it's like make, model, year, all the specifics there, everything you can imagine. So that's why each vehicle is specifically identified by that VIN. So when you go to sell that as a dealer, it's very simple. What were we invoiced, by the company that makes the cars for us, or what was our cost if it was, let's say, a vehicle that they got in a trade-in or something, and there was some associated cost to that. Whatever it is, they can track exactly what they paid for that. What was their cost out of pocket? Excuse me. So when they sell it, that's exactly the cost of goods sold. So it's simple. Now you can apply this same idea to homogeneous inventory, but it gets a little bit more involved, because that means your barcoding system would have to identify each layer of inventory, as you're acquiring it. So it's possible, but again, some companies are like, well, who really cares about that? We don't need to be that, exacting for this. We're just saying, hey, this is what we believe, or what we're assuming goods are being sold in the business. And again, that's an important point that I'll get to in a moment. The first thing to consider when you're doing these assumptions is you have to stick to it. You have to stick to the assumption, and this is for each class of inventory. So if a business had several classes of inventory, they could pick different cost flow assumptions. So they could have one class at FIFO, one LIFO, and one average cost, totally acceptable. But they still, within each class, have to maintain that same accounting practice, that same assumption. Otherwise, if they change to a new assumption, then they're going to have to deal with changes in accounting assumptions, which we'll discuss shortly enough here. All right, so again, you have to understand here, like, why do we have to pick a cost flow assumption in the first place? Just because it's homogeneous? No, because of this reality right here. We're not paying the same for every unit, right? 92, 98, 103, 106. So implicitly, different cost flow assumptions will yield different outcomes. That's the reality of what we're dealing with. Okay, so the first one we're going to tackle is periodic first in, first out. Again, we'll look at perpetual inventory. That's in another video. So the periodic system is basically we're analyzing all the data for the period. Now, this one, to go over the basics here, means we're assuming that we're selling from oldest to newest stuff. Let me give you a visual here. Oldest to newest would be like if you go into a convenience store and they have a dispenser for beverages. It's on a slant and it slides forward toward the consumer. And guess what? The first units in there are the first units that are taken out. I don't, as a practice, see anybody reach to the units in the back. There's no practicality to that. That would also be the less cold units as well. It would be the ones that maybe were just put in and they're not even chilled yet. So first stuff in is the first stuff out in that. Again, that's the visual there that I want you to think of. So what is the reality of what's going on here? Let me go back to the previous slide, and I will do a little bit of neatening here, not a lot, just sort of clear that area out. So we're selling goods, and again, this is for first in, first out. We're selling goods in this direction. So that's where cost, which I'll attempt to draw there. Oh, that's not too bad. Cost is happening in that direction, so that means inventory, because it's just two components here, cost of goods sold versus the value of our inventory. So inventory is happening from the opposite direction, meaning inventory should be our newest stuff. So if you ask yourself, which is easier to analyze, the units that we sold or the units that we still have on hand is usually simpler because it's fewer units. Now, this is not that complicated of an example compared to something I could devise with, let's say, 12 or 13 or 14 purchases. Still, that's the reality. So we're going to analyze inventory and back into cost, because remember, we're just taking this figure and splitting it into two piles. So if we understand the cost of what's still around, we subtract that from the 219.7, that would give us the cost of what was sold. So what's still in inventory is going to be obviously whatever's on the bottom here, the 100 at 106, and 100 units at 103. So that's what you'll see here, is I'm just saying that's what we still have on hand. So we still have 100, all of the last purchase plus only 100 of the units at 103 are still on hand. Total, and we get 20,900. And as I promised, we're going to take that number and subtract it from the cost that was available. So that will give us cost of goods sold of 198.8. as a result of that. So the formula we get out of this is take cost of what's available minus ending inventory, and we get cost of goods sold. Also, you could exchange those two elements and say equally true. Cost of goods available for sale minus cost of goods sold equals ending inventory. All right, so that's first in, first out. Next up is last in, first out. So now what are we doing? We're reversing everything we just basically said. Now we're selling from newest to oldest. I will give you a visual on this one as well. So here, think of it in these terms. So this is going back to my childhood when I remember seeing a sand pile at a lumber yard when I was a kid. And that was just so that, you know, parents who built sandboxes would take sand out the sand pile and, you know, put that in the sandbox at their yard. And of course, how does that work in terms of like how is sand being removed? Well, it's just a sand pile. So whenever they dump, you know, where they bought new sand, the lumberyard did, they just dumped new sand on top of the old sand. And as a, you know, rule, people don't dig to the bottom of the sand pile for the old sand. Who cares? You just take it off the top. So in other words, the last sand on the piles of first sand off the pile. So last on, first off, or think of it that way. That would make it LIFO, which is a little weird, but again, last stuff we got in, first stuff out. So that means, as a consequence of that, whatever I said here is now going to reverse. So I just got to reverse my notation. So now we have cost happening down here. I'm grateful that's a short word, but and this one I will of course just shorten to INV. Inventory is happening from that direction. Oh, I probably should just adjust my line slightly here because again, inventory is a smaller portion of what we're dealing with here. Cost happening that direction, inventory this direction. And what's the reality? Well, so we sold our new stuff, old stuff is still on hand according to last in, first out. So what's our oldest stuff? Well, that's 200 units at 92. So what you'll observe here is that guess what? Our ending inventory is really just our beginning inventory. It's our beginning inventory just got folded over to ending inventory according to this assumption. So 18,400 is what we're going to say is still in inventory, and we're going to subtract that from the 219.7, what's available. So what was sold is basically the $201,300, which would represent the cost of all of our purchases. That's the assumption here. Now, before we go to the third one, the average cost, we've got to do a comparative analysis of FIFO and LIFO because there's some advantages or potentially disadvantages of those. But I phrase everything in terms of advantages here in this table. All we care about is FIFO versus LIFO because there's no advantage or disadvantage to the average cost because we're just averaging everything. Right? So I frame this in terms of a bit of a situation, a scenario where we have a business manager who enters into a bonus agreement based on maximizing net income, and they're able to choose cost flow assumptions. Which should we choose, assuming a costs are expected to continue to rise in the foreseeable future? Okay, so you have a period of increasing costs, which you'll note is exactly what I gave you in my example. Cost went from 92 to 106, so we have that situation. Okay, so which method gives you the highest net income? Because that's how I phrased it here, just two possibilities. Highest net income, lowest income tax expense. So we would pick first in, first out because we're in this period, inventory costs increasing, and we want to be in this box, highest net income. Now, just as the proof of that, what's the proof there? Okay, again, a little cleanup is in order so we can see some of the numbers here. Oh, I wish the eraser was a little bit larger, but that's good enough for now. All right, so we're over here. And just neaten that up just a bit more. Okay, so what's the reality of our cost of goods sold one versus the other? We have 198.8 here. It was 201.3 there. So the logic here is which one was smaller? Well, first in, first out was smaller because why? As a consequence of having smaller cost of goods sold, you have what? Higher gross profit, which means you have a higher net income, as opposed to last in, first out, which would give you a lesser one. Again, what's the advantage of that one? I'll just refer to it quickly. The advantage of that one would be in the same period, lowest income tax expense. Again, same logic, but we're just now looking at the opposing point of view. Now, because we have a higher cost of goods sold than first in, first out, now our gross profit is smaller, our net income is smaller, and of course that means income tax is smaller. So that's why we would say that's the benefit of that one. So she would choose first in, first out, because that's the one that's giving her the maximum possible net income as a result of that. Now let's say this remains true for 2 years, and then we get to the third year, and now we see inventory costs decline. Oops. All right, so we are declining inventory costs, so now our costs are going the other way. So now here's where we're at. We're in that column here, which of course means if we stick with first in, first out, this is where we're at. Yeah, the advantage is lower income taxes, but again, if your bonus is predicated on what the company makes income, now your bonus is going to go down. So she might think, well, I want to keep this going, so I want to move to this box. I want to migrate to this box. So therefore, we'll just choose LIFO now. Now, again, what's the reality here? The reality is if she did make that choice, okay, so this is what we have. There's our 3 years. Ooh, that 2 got out of hand. Oh, that 3 does not look good either. So again, I'll just abbreviate. I'm just, for purposes of sparing me and Hugh, watching me try to draw this stuff there. All right, so we got FIFO, LIFO in the third year. That's the way she divides it. But guess what? What's going to happen is we're going to say, oh, that's great. If you change to LIFO in this year, we're going to make you go back to years 1 and 2. Whoops, didn't mean to get rid of that one. Got out of hand. And we're going to say, okay, that means you got to show LIFO in the previous 2 years. So because they all have to match, right? These all have to be the same cost flow assumption. LIFO, all have to be the same. Now what happens then is that she would migrate in those years 1 and 2, because now we're in the LIFO box. So in other words, 1 and 2 would be here. So we'd have lowest income tax expense, which means what? Income would be revised downward. So the way I think of it as if that would happen, we would have to probably say, well, guess what? We're going to take some of your bonus back. We're going to claw some of that back because we revised our income downward. So what we're basically saying is stick to a method, because again, if you change it, we're going to make you go revise previous periods as if you're using a new method. Now, and again, in some cases, if we have a company been using something for a long time, one of these assumptions, we might get into the dicey area of cumulative effects of changes in accounting assumptions. Again, these can sometimes be impractical, impractical or impossible to determine. So you might just simply leave the revision of the current periods, and that's all we would do there. Oh, and just one side note, in case I didn't mention, I may have. This is an assumption. So the rule here is your actual costs in your business do not have to match the assumption. It's just an assumption of how we're going to account for it. It could actually flow, like you could actually see your business, in reality, units are going out the door, first in, first out, and still use last in, first out. That's not a problem. This is just an accounting assumption. We're not trying to reflect the reality of how goods are actually being sold. Now, lastly, we have periodic average cost, which is, I think, very straightforward here. Again, we're going to utilize a weighted average cost, which is defined as taking cost of what's available divided by units available. So I'll go back to the initial slide here, which is desperately in need of some housekeeping there. There we go. Just kind of take all this stuff out here. All right, so what we're going to do is we're going to take units you had, and we're going to divide that into the cost that was available for sale. Now, the idea here is what you'll observe is that because we do that, whatever units we have the most of at a specific cost is where that average will gravitate toward. Now, we could do this, which is take all of the units we have here. So we could add that up, and we get $3.99, and we could divide that by 4, and we would get $99.75 a unit. That's called a straight average. In other words, we're not taking into account how many units we had in any one layer here. So we should see the average by a weighted average gravitate very closely to the 1,000 units at 98, because that's the most we had there. So when we look at the actual calculation here, we get 99.86. So actually, just because of the numbers I chose, it gravitates pretty close to a straight average. But in other examples, you may not observe that to be the reality. So that's why I always have you choose a weighted average. And so we're going to apply that figure to the 200 units. 200 times that, so we get 19,973 as the cost for ending inventory, same as before. Subtract that from what's available to get cost of goods sold, in this case of $199,727. Of course, you would observe that the ending inventory and the cost of goods sold are between the LIFO and FIFO numbers because it's just an average. Right, that concludes the periodic video here. Look in the next video for the analysis of perpetual systems.